Welcome back to Intermediate Accounting. This video, we continue Chapter 17, Accounting for Investments. And specifically, we're looking at the accounting treatment for equity investments. When a company is first purchasing the equity investments of another company, we record that acquisition or debit equity investments at the purchase price, and we also include the broker's commissions and any fees related to the purchase. Remember when we were accounting for debt investments, we said there's three categories of accounting treatment depending on management's intent. Does management plan to hold those debt investments to maturity, actively trade them, or hold them as available for sale? Accounting for equity securities also has three different categories, but they are not related to management's intent. Instead, the accounting treatment for equity investments is dependent on the degree to which one corporation, the investor, the company that's buying the shares, what percent of ownership do they have in the investee company? And here we see the accounting treatment for equity investments summarized. If the investor has greater than 0%, but up to about 20% of the shares of the investee company, then we use what's called the fair value method. If the investor company buys about more than 20%, but less than 50% of the ownership or the total shares of the investee corporation, then the investor company uses what's called the equity method. And we look at the fair value method and the equity method, work through some examples in this video. If the investor company owns more than 50%, any more than 50% of the investee's total shares, then we use what's called the consolidation method, meaning that the investor fully consolidates 100% of the investee company's assets, liabilities, equity, and income. And examples of consolidating the parent's financial statements with those of the subsidiary is covered in advanced accounting. Now let's get started by taking some notes on these different types of accounting treatment and working through some examples. Let's look at these three accounting methods one at a time. We'll write down the notes, and then as we continue throughout this video, we're going to look at each of these three methods in more detail and with examples. Let's start with holdings less than 20%. You buy one or just some shares of common stock of another company. We are going to record those shares, that investment, that equity investment, at fair value. And these notes that you see, this asterisk you see here, relates to this fair value holdings of less than 20%. What does this mean? Well, we report the investment on the balance sheet at fair value, and really important is we record the unrealized gains and losses through net income. So whereas on held to maturity debt securities, we reported the unrealized gains and losses on equity, here we're going to go directly to net income. So those unrealized gains and losses are recognized in net income. And other income effects, these are equity securities. We're not going to receive interest, but what do we call those cash payments that we might get off of an equity security? Dividends. We're going to record them as dividend revenue when they're declared. And what else might go through income gains and losses upon sale? Now let's look at the overview of holdings between 20 and 50%. The valuation is called equity. We call this the equity method. Unrealized holding gains and losses are not recognized. And what do we recognize in income? A proportionate share of the investee's net income. We'll look at that more closely later on in this video. And holdings of more than 50%, we use the consolidation method. Unrealized holding gains and losses are not recognized. And we don't have anything else coming through income. We just simply consolidate the two income statements, the two balance sheets of the other company that we have holdings of more than 50% in. Let's get started by looking in detail at these holdings of less than 20%. Here's an example. On November 3rd, 2020, Republic Corporation purchased common stock of 3 companies, each investment representing less than a 20% interest. So we know that if it's less than 20%, we know that we're going to be using the fair value method. Here's our portfolio of 3 equity securities and the total cost. Let's record that journal entry for purchasing the equity investment. To debit the account equity investment, at the total amount, $718,550, and we paid cash to acquire this investment. Cash decreases at $718,550. On December 6, 2020, Republic receives a cash dividend of $4,200 from the Campbell Soup Company from one of its investment. We receive a dividend. So now we need to record the entry for that dividend revenue that we received from our investment. Now when we receive dividends, what we are getting is cash. So we debit cash for the amount of the dividends, $4,200, and we credit the account dividend revenue. Now we reach year end, it's time to put together the financial statements, and we need the fair values of the equity portfolio, all these 3 securities together. So we're maintaining the cost. We're also at year end putting together the fair values. We're given this information of the fair values. And the difference between the cost and the fair value is an unrealized gain. Here we see that if the numbers are in parentheses, that's calculated as a loss. We take the fair values minus the cost of the securities. We're going in the direction of fair value minus cost equals the unrealized gain. And when we sum up the 3, we net the net unrealized gains or losses, we get a net loss of $35,550. We're given the fact that the fair value adjustment account has a balance of 0, so we know that we need to record a fair value adjustment just like we did with our available for sale securities and our trading debt securities. Fair value adjustment credit for $35,550. So let's record that entry. Again, the credit, I'm going to start with my credit to fair value adjustment for $35,550. And so far our entry is similar to the available for sale and trading debt investments. But what differs from available for sale debt investments when we're using equity securities, the other side of this entry, the unrealized holding gain or loss, does not go to equity, it goes directly to income. So our debit is to unrealized holding gain or loss. In this case, when we're debiting the account, it's a loss. And the loss goes directly through net income. Equity securities, we never use that equity. We never use unrealized holding gains and losses dash equity. Next, on January 23rd, 2021, Republic sold all of its Northwest Industries common stock and received net proceeds, or in other words, cash, of $287,220. We are asked to record the entry for this sale. So we're selling securities, we're selling our equity investments, we receive cash, $287,220, and we need to remove the equity securities. So we're going to credit to reduce the account equity investments. And the question is, at what amount do we remove these equity investments? Do we remove them at the cost of those equity securities or the fair value? And the answer is, well, we never actually changed the Northwest Securities account from cost to fair value. We tracked the portfolio's change in fair value in a separate account called fair value adjustment. So we're going to remove these securities at their acquisition cost, 259,700. And the difference between the cash that we received and the book value or the initial cost of those equity investments goes to a gain or loss on sale. And since we received more cash than the book value of those equity investments, this of course would be a gain on sale. And so here this amount is the difference between the 287, 220 and the 259, 700. Cash received less the cost on the books. And that gives us 27,520. Now, assume that on February 10th, 2021, Republic purchased 20,000 shares of a new stock, Continental Trucking, at a price of $12.75 per share, plus brokerage commissions of $18.50. So the total cost was $256,850. So here we're saying we're not asked to record this journal entry. If we were, we would just debit the equity investments account for the total cost, $256,850, and credit cash. So we're shown here the initial costs of all of our investments. We're given the fair values, and we're also shown those differences between fair value minus cost as an unrealized gain, or if in parentheses, an unrealized loss. We previously booked the $35,550 as a credit to the fair value adjustment account, and that helps us determine if we want our total fair value account to have a balance. This is our required balance in the fair value adjustment account. We want it to have a $64,250 debit balance because our fair values are net higher than the costs, and it currently has a credit balance. So what do we need to record in the fair value adjustment account? We need to record $99,800 as a debit. So let's record that journal entry. Debit, fair value adjustment, $99,800, and credit, unrealized holding gain or loss, dash income, $99,800. And if we did a T account for all the activity in the fair value adjustment account, what we see, our beginning balance was 0. We had booked a credit of $35,550 at the end of the first year. And then we book now a debit of $99,800. So what is our balance in here? When we take $99,800 and subtract out $35,550, we get $64,250 as a debit, which is exactly what we wanted it to be, $64,250. Let's move on to the next method, the equity and consolidation methods of accounting, but we're really focused on right now the Equidate method. When an investor has holdings, equity holdings between 20 and 50% of the investee's stock, we use the equity method. So an investment, whether it's direct or indirect, of 20% or more of the voting stock of an investee should lead to the presumption that in absence of evidence to the contrary, so if we don't know anything else, no special situation, that the investor has the ability to exercise what we call significant influence. If you own more than 20% in another company's stock, we say that you would have significant influence over that investee. In instances of significant influence, the investor must account for the investment using what we call the equity method. And significant is where we're defining significant between 20 and 50%. If we exceed the 50% thresholds, we call that something different besides significant, and we'll get to that later. Right now, we're focused on the 20 to 50% range of ownership. When we own between 20 and 50% of another company's stock, we record the investment at cost, and subsequently we adjust the amount each period for not changes in fair values, but the investor's proportionate share of the earnings or losses of that investee company and dividends received by the investor. If an investor's share of the investee's losses exceeds the carrying amount or the cost or the book value of that investment, then the investor typically would stop using the equity method and stop recognizing additional losses. Let's take a look at an example. On January 2nd, 2020, Maxi Company acquired 48,000 shares, 20% of Mini Company's common stock, at a cost of $10 per share. Now, if you're right at that borderline 20%, the company really has to use some discretion and say, do we feel that we have significant influence over this investee company? Let's say that decision was made, and Maxi does decide that it has significant influence over Mini, and therefore it's going to use the equity method. When Maxi, we're doing the books from Maxi's perspective, so when Maxi makes this investment, they're recording equity and debit to equity investments, and crediting cash, of course, for $480,000. For the year 2020, Mini Company reported net income of $200,000. Maxi Company's share is 20%. So what do? We say if Mini is a big part of, we own a significant portion of Mini, we have significant influence over it. So instead of looking at changes in fair values, we're going to say we own 20% of the 200,000. Our portion of ownership is that 40,000. And the way that we account for that is we increase the value of our equity investments. So we debit to increase equity investments by 40,000. So the investee's income multiplied by our percentage ownership. And then we're going to credit the account investment income. The next thing we see here at December 31st, 2020, the 48,000 shares of Mini Company have a fair value market price of $12 per share. So the question is, do we do anything about the changes in fair value of the investee company's stock? And the answer is ignore. There's no entry. This is not the fair, we would only use this if we're applying the fair value accounting, and we're not, we're applying the equity method of accounting. The example continues. On January 28th, 2021, Mini Company announced and paid a cash dividend of $100,000. Maxi Company received 20% or $20,000. So we need to record the receipt of dividends. How do we do that? Well, what are dividends? What is Maxi Company getting? Maxi Company is receiving cash of $20,000. And we are an investor in Mini Company, but we have significant influence over, we have a large stake in Mini Company. So what we say is that getting these dividends is not so much income to us as it is actually a reduction of our equity investment. Think about what dividends do to Mini Company. They reduce stockholders' equity. They reduce retained earnings. So if we have a large enough stake in Mini Company, it's actually reducing the value of our equity investment. Let's just make a note of that. So dividends reduce the equity investment under the equity method. Okay, for the year 2020, Mini reported a net loss of $50,000. Maxi Company's share is 20% or $10,000. Now we do need to record that loss. How do we record that loss? Remember when we had a net income, we debited to increase the equity investment account, and we credited to increase investment income. Now we're going to flip these two. We need to decrease So we're going to credit the equity investment account, 10,000, and we are going to debit the account investment loss for 10,000. And the last thing we see here in this example is that December 31st, 2021, the mini company's 48,000 shares have a fair value market price of $11 per share. And we know from the last example of the last slide that we ignore the market price. There's no entry that's needed. Now, let's look at the fair value method versus the equity method side by side for these two transactions. So under the fair value method, remember, we did say there's 20% ownership. So let's take two different assumptions. One is assumption that Maxi Company does not have significant influence over Mini, and one that it does have significant influence. And so the equities method is used. Okay, so under the fair value method, if we are just recording the unrealized gains and losses each period and dividends are revenue, what would happen on the day that we're recording the actual investment? Well, there's actually no difference. Either way, we debit equity investments for 480,000 and credit cash, 480,000. This is regardless of whether the fair value method or the equity method is used. But now let's move on to the other transactions so that we can see some differences here. For the year 2020, Mini Company reported net income of 200,000. Maxi Company's share is 20%. Well, under the fair value method, we don't do anything about that. We say we own such a small percentage that it doesn't really matter. And then what did we say under the equity method? We say the value of our investment increases, so we debit to increase equity investments for the 40,000, and we credit to increase investment income for 40,000. And how about this next transaction, or this next item here? At December 31st, 2020, the shares have a fair value market price of $12 per share, total market value of $576,000. Well, under the fair value method, we need to record an increase to the investment asset, and we do that not directly to the equity investment account, but we use the separate fair value adjustment account. So we debit to increase the investment. The difference between, so here we have that it's worth 576. What is the cost? Was 480. So let's take the difference between, by how much does the fair value exceed the cost of those of the investments? 96,000. So we increase the fair value adjustment, increase our assets by 96,000, and then we credit the account unrealized holding gains and losses dash income for 96,000. What would we do under the equity method? Nothing. We would ignore it. We're ignoring those fair values. Under the equity method, we'll see in this next slide, what we care about is, or what we saw in the last slide, what we care about is this equity, the investees' net income. We have a proportion of that. Okay, moving on to the next item. On January 28th, 2021, Mini Company announced and paid a cash dividend of 100,000. Maxi Company received 20% or $20,000. Either example, in either case, whether we're looking at the fair value method or the equity method, when we receive a dividend, we receive cash. What changes is the other side of this journal entry. But regardless of the accounting treatment, we get cash of 20,000. If we're using the fair value method, we record the other side of the entry to dividend revenue So we're going to see this on the income statement. But if we were using the equity method, remember those dividends actually reduce the value of our equity investment, of that asset account equity investment. Next item for the year 2021, Mini reported a net loss of 50,000. Maxi Company's share is 20% or 10,000. So under the fair value method, we don't care. So there is no entry here. We can just ignore this. But under the equity method, remember we have an investment loss debit to reduce income for the account investment loss, and we credit the account to reduce equity investment. And our last item here, December 31st, 2021, Mini Company has 48,000 shares. They have a fair value market price of 11 per share, or 528,000. For the fair value method, we do have to account for this unrealized gain or loss. So we need to know what is our balance in the equity investments account after accounting for the fair value adjustment. So if I want to look at these two together, the equity investments plus the fair value adjustment together, because that's what gets reported on the balance sheet. Well, when I purchased the equity investments, we recorded them at 480,000. And then remember, December 31st of 2020, we recorded a fair value adjustment that was a debit of 96,000. So currently, before we book any entry, we're showing the net amount of the equity investment, including the fair value adjustment of 576,000. That was the fair value last year end. And now we see that the balance needs to be 528,000. So the question is, what do we need to book right now? If we have a balance of 576,000 and we want to have a balance of 528,000, what do we need to record? Well, clearly we need to take the balance down, so I need to record a credit of how much? The difference between 576 and 528. We need to record a credit for 48,000. So we are reducing the fair value adjustment account. So we're going to credit the fair value adjustment account, 48,000. And I'm going to debit the account unrealized holding gain or loss dash income for 48,000. And what do we do under the equity method? Remember, under the equity method, we ignore these unrealized gains and losses due to changes in fair values. Here we can see a summary. You can pause and look over this, but this shows side by side every one of the events or transactions and how the accounting differs between the fair value method and the equity method. Our last category is holdings of more than 50%. And we don't need to work through any examples here. In fact, in advanced accounting, you will be spending time consolidating two sets of financials, the parent and the subsidiary. But in this class, all we need to know is if you hold more than 50% of the investee's common stock, you consolidate. This is the GAAP's rule. So one corporation, we call it the parent, acquires a voting interest or controlling interest of more than 50% in another corporation. We call that the subsidiary. And the parent corporation is referred to as the parent. The investee corporation, the one whose stock is being sold, is referred to as the subsidiary. And the investment in the subsidiary is reported on the parent's balance sheet. As a long-term investment. And generally, the parent is going to prepare consolidated financial statements. Again, we don't see any examples of working through holdings of more than 50% because that accounting treatment is consolidating the two sets, the subsidiary together with the parent's financial statements, and that's covered in advanced accounting. To conclude, let's look at a summary of the accounting treatment for equity securities. If the investor holds less than 20% of the investee's equities, we report the equity investment at fair value. Dividends are recognized as revenue, and unrealized gains and losses are recognized in income. If the investor has holdings between 20 and 50% of the investee's equity, the investor uses the equity method. Investments are originally recorded at costs, and then they are adjusted for the investor's share of the investee's income or loss. The equity investment is decreased by dividends that are received from the investee. Other income effects, revenue is recognized to the extent of the investee's income or loss. Holdings of more than 50%, we just need to remember this one rule. We don't actually have to apply it until you reach advanced accounting, consolidation of financial statements.